Welcome to this video on Operation Beachhead. We are analyzing the market impact of the Hynix ADR landing on US soil, the implications of a specific capex head fake, and why smart money is moving early. In this first act, we provide a situational report. We are seeing massive swings across the market tape, a technical setup on the S&P, and a warning signal on the NASDAQ, all leading up to a major event tomorrow. Reviewing today's close, the S&P 500 has a workable setup, though it struggles to reclaim the overhead put wall. The NASDAQ held the 55-day moving average, but with key shorter-term averages declining, this signal remains uncertain. The current market situation is not great, but it is not broken. We are tracking a moving average system based on the 12, 22, and 55-day averages. While history suggests a potential reversal, we are waiting for tomorrow's event to force the next move. The core objective of our operation is to identify how institutional players are reacting to key market levels, allowing us to anticipate their moves before they happen. Our framework relies on three pillars: macro, fundamental, and technical analysis. Tomorrow, these three pillars converge on a single, pivotal event. Tomorrow features three catalysts: the Hynix ADR listing, options expiration, and the lead-up to a long weekend. These factors are why today's market positioning is so critical. In Act 2, we focus on the beachhead. SKHY, a major global DRAM manufacturer, is listing an American depositary receipt in the US tomorrow. This is a direct US listing rather than a classic IPO. Each ADR represents 1/10 of a Korean share, expected to price around $149. We expect activity to pick up tomorrow with the new ticker, SKHY. With a $28 to $30 billion raise, demand for this offering has been substantial. Because the offering is oversubscribed, allocations will be cut, leading investors to pursue additional shares on the secondary market. The product here is access. Most US platforms face friction when trading foreign stocks. This ADR removes that barrier, allowing capital to move directly into the name rather than through broader, less efficient ETFs. We see a precedent in Taiwan Semiconductor. Its US ADR commands a premium because investors prioritize access and convenience. We expect the market to handle the SK Hynix listing similarly. Samsung and Hynix together represent nearly half of the Korean market flow. A direct line for Hynix will likely shift how this capital is managed. The question is whether broad Korea flows will slow. If investors can buy SKHY directly in New York, the need to hold the EWY wrapper decreases. This indicates a potential rotation, not a bearish stance on Korea itself. We are watching the EWY and KORU tickers closely at the open for evidence of this rotation. Whether this is early institutional positioning or a natural market shift, the stall is already appearing on our charts. Looking ahead to tomorrow, there are two primary scenarios. In the base case, the ADR trades at a premium due to high demand, effectively drawing in capital and mirroring the TSM template. In the risk case, domestic Korean inflows could stall if liquidity shifts heavily toward the new US ADR. Ultimately, the market is constrained by finite capital. Whether we look at institutions, hedge funds, or pension funds, they all operate within a limited pool of money, which explains the dynamics we expect to see tomorrow. To trade this effectively, you must understand what you are holding. We are dealing with DRAM, the core working memory required by AI data centers. Because Hynix is a major player, this is a significant listing, not a niche opportunity. Consider the valuation gap. Korea-listed memory names are trading at 6 to 7 times earnings. If you compare this to US-listed competitors, the growth potential at a cheaper multiple makes this an attractive proposition for fund managers. In summary, SKHY lists tomorrow as a major, oversubscribed event. We expect the ADR to trade higher on trapped demand. But the real story is the potential for capital to rotate out of broader ETFs like EWY or KORU to make room. Moving to Act 3, we analyze the semiconductor index, which hit a wall today. Across the sector, major names encountered their 12 and 22-day moving averages and effectively stalled. The SOXX index rallied today on capital expenditure headlines, but the gains were met with resistance. Being compressed between the 12, 22, and 55-day averages creates a technical bottleneck that demands a clear catalyst to break. It is important to note that a pause is not the same as a breakdown. We believe this represents rotation through sectors rather than a single definitive trend. We are currently observing this consolidation phase. For specific names like KLAC and Lam Research, we see the same behavior, a rally followed by a stall at the 22-day average. These technical levels acted as clear exit points for traders who were previously trapped in earlier gaps. The consistency across the board is telling. From SOXX and KLAC to Micron and SanDisk, almost every major semiconductor name hit resistance at these exact moving averages, signaling uniform seller behavior. When multiple stocks exhibit the same technical reaction, it is rarely a coincidence. It is an indication that the market is respecting a specific set of levels across the entire sector. The 12 and 22-day averages capture short-term momentum, while the 55-day average serves as the institutional benchmark. Right now, the market is compressed between these lines, awaiting the next major catalyst. The buys we executed yesterday were based purely on these technical signals. As they held support, we anticipated the move that followed once the headlines hit. Frameworks, not luck, allow for this kind of positioning. To play this consolidation, we need to distinguish between a pause and a breakdown. A true breakdown occurs when the 55-day average fails on a daily close and volatility expands significantly to the downside. In conclusion, keep your eyes on the 12-20 seconds resistance and the 55-day support level. Tomorrow serves as the catalyst that will decide whether this sector continues its consolidation or breaks into a new direction. We are now at a critical juncture where two truths coexist. Markets can consolidate after massive moves, yet hitting a key resistance level today brought that momentum to a complete halt. As we wrap up Act 3, remember the memory and semiconductor complex hit resistance and froze in unison. Whether this is healthy digestion or distribution depends on tomorrow's Hynix listing. Follow the levels, not predictions. Moving into Act 4, we address the capex head fake. The street was convinced that spending cuts were imminent, but recent data from Meta and Amazon suggests the exact opposite. The bear thesis centered on hyperscalers slashing budgets. However, Meta's strategy has shifted toward expansion and subscription services, while Amazon is leveraging debt to fuel continued growth, effectively invalidating the quote cuts first narrative. Consider the math. A rule of thumb suggests about $20 billion per gigawatt of data center capacity. By announcing multi-gigawatt targets, these companies are signaling massive, long-term capital commitment. Meta's trading day was a masterclass in market psychology. A gap down on margin fears turned into a monster rally once the strategy for monetizing capacity was clarified. The skeptics essentially funded the move. Amazon is joining the charge, raising $28 billion in bonds to fund further capital expenditure. You do not take on that level of debt to shrink operations. Follow the money, specifically the purchase orders. Meta is locking in long-term supply agreements with major memory providers. If you want to know who is being paid, look at who is supplying the hardware. The chain reaction was clear. The capex narrative reversed, memory stocks ripped, investors scrambled back in, and finally, the entire sector hit resistance. Watching Micron's performance into the Hynix listing will be key. The prevailing market idea that capex is dying is fundamentally disconnected from the reality of these massive infrastructure buildouts. This has been the most mispriced narrative of the week. We must verify our assumptions with actual earnings data. If the numbers align with the math we have seen, the memory demand story remains valid. If not, the squeeze was purely positioning. The list of direct beneficiaries includes Samsung, SanDisk, and SK Hynix. The complication arises with Micron, which faces competition from a new, cheaper listing, while the overall demand remains high. The scale of this build-out is unprecedented, with targets reaching hundreds of billions of dollars. There are only 4 companies that can physically support this kind of infrastructure, which makes them central to the sector. In conclusion for Act 4, capex is accelerating. While demand is not the question, capital allocation is. This zero-sum competition for investment is where the volatility and the real opportunities reside. Finally, we reach Act 5, the volume trade. While broader indices seem calm, single-name implied volatility is rising. That is where we find the opportunity in this market climate. Looking at the VIX, you might think nothing is happening. But if you look a layer deeper, memory-related stocks are pricing in 99th percentile implied volatility. While average true range, or ATR, has peaked and flattened, options are still priced for the old regime. When realized movement flattens but implied volatility stays high, one of them is likely wrong, and it is usually the implied side. In this environment, selling puts is often a superior strategy to owning stock. It allows you to collect premium during an IV spike. Market consolidation then becomes a winning scenario as theta bleeds and gamma evaporates. By selling into the panic, you allow time and volatility contraction to work in your favor. As the market moves in a choppy sideways pattern, the premium can collapse significantly, providing a clear edge. To walk through the trade, we sold to open puts at the close, targeting the panic bid. We also utilized longer-dated August tranches for more runway. The subsequent gap up caused a 90% collapse in short-dated premium, monetizing our volatility edge. Shorting puts turns violent chop into a source of income. Instead of being shaken out by directionless volatility, you are paid for the time as the market consolidates, offering optionality over simple ownership. Technical structures remain critical. One name recently completed a textbook head and shoulders pattern. After hitting a 20% move, it returned to retest the neckline. Holding that level is key. Failing it flips the level to resistance. It is not an exact science, but having a plan around these measured moves is essential. We monitor the retest of the neckline to decide if we need to repair the trade or prepare for a second leg. The bottom line is that index volatility may be quiet, but single-name volatility is extreme. Trade the layer that is actually mispriced. Now, it is time for the Micron conversation. Micron closed with a shooting star pattern heading into a major memory listing. Is this a coincidence? Let's analyze the precedent set by SpaceX. Why is Micron weak right now? Despite positive headlines, it rejected a key level and closed at its lows, forming a shooting star before a major sector competitor lists. We are positioned short into this event. The SpaceX Playbook demonstrates that institutional money often rotates out of proxy stocks 2 weeks before a major, best-in-class debut. We are watching Micron closely for a similar pattern. When SpaceX listed, the Space ETF peaked 2 weeks earlier. Institutional investors cleared their holdings to make room for the new entry, and those proxy assets never reclaimed their prior highs. We are seeing similar dynamics today. Funds do not just buy categories, they chase what they view as best-in-class. When that entity arrives, proxies get abandoned. These are market facts, and the goal is to get ahead of the move. The value of studying these precedents is clear. When you understand why a market event happens, you can recognize it when it repeats, allowing you to anticipate what it might become. Let's break down the thesis. If you are a pension fund capped at 10% memory exposure, you want the best name. Hynix is growing faster than Micron, at a fraction of the multiple, and now it is accessible without the old friction. The trade is simple. You sell the Micron, lock in the gains, and move the capital into Hynix. This rotation is likely driving the current pressure on the Micron chart. Does this mean the entire semiconductor space is in trouble? Likely not. Nvidia and its peers remain a different animal, and broad capital expenditure demand continues to support the complex. However, for DRAM-specific exposure, watch out. Hynix is a direct substitution. If you hold DRAM baskets, be aware that supply pressure is possible as portfolios rebalance. We are tracking specific trade maps. For Micron, we see a shooting star into the event, with a short position in place and clear rejection at the 22-day moving average. For Hynix, our lean is upward, driven by pricing power, oversubscription, and trapped demand. Meanwhile, we are monitoring the broader Korean equity wrappers for signs of flow bleed. The bottom line is that the precedent holds. Proxies are sold before the best-in-class, not after. Micron's weakness on a strong sector day is the tell we were looking for. Tomorrow provides the answers. This is exactly why we stick to our rules of engagement, monitoring levels, catalysts, and maintaining the discipline to trade the tape as it unfolds, not as we predict. Our battle map includes Hynix, the SOXX index, and the NASDAQ. We are watching the Micron 22-day EMA and the neckline retest, which will determine if the rotation thesis stays live. Get through the event. Trade what is actually happening. Then, go from there. Join us for our morning pre-market calls and stay disciplined.